shows, I've taken, I used to be of the mind that everything has to be polished and really look buttoned up. And then I kind of watched a lot of these like YouTube shows that are popular, like not a huge Pat McAfee viewer, but I kind of like that very casual, we're all just hanging out talking. I feel like Real Fridays is still that.
I like when they cut to what's his name? The guy AJ Hawk, the guy that played for the Packers for like 10 years, 15 years. I like when they just cut to him and he's like sitting in another part of the studio, like alone, and he just is like has some like really aggressive take about something. Then he won't say anything for 30 minutes.
Exactly.
But so here we are on Real Fridays. Dr. Rick Rock is getting off a plane right now. He'll be with us shortly. For those of you that joined for Rick's 2 cents on the news of the day. But how's everything going in your world, Jeremy?
Yeah, I think this week was pretty busy in terms of industry news, in terms of people asking questions, what's next, what's happening. I feel like at least because a lot of what I do spans real estate, mortgage, and title, it's just been a rolling news cycle. I was even
there's all like the title, like hacking and all that stuff like 2 months ago, and then
you
real
go
estate
all the way
the past month, mortgage the past week. Yeah,
it's funny you mentioned the hacking, because in my mind, I was trying to remember which was first, the State of the Union where the president mentioned title insurance, or the NAR settlement, which was like a Friday surprise. I think it was back-to-back days. I think it was like the title insurance thing was a Thursday, the NAR thing was that next Friday or something like that. But
yeah, it's been a whirlwind since then. I thought you were going to take it back even to like a month or two earlier.
Wow,
with all the
that's a good point.
All the hacking news, that was brutal, and I know affected you a lot. Yeah, with your businesses. Yeah,
especially because anybody who processes orders, if there's a delay, that's it, man. You're frozen. So revenue's frozen, deals are frozen, everybody's scrambling. So yeah, I appreciate that. Other than that, I think the real question is, especially for somebody like me that's always talking about the next thing, the new thing, what are the companies thinking and doing? This has just been a wild week where we're far enough removed from some of that news where like we're starting to see a shift in people trying different things relative to real estate, joint ventures, mortgage. And then of course we've got, on top of all of that, Hunter Brooks' story on UWM. So it sort of just became like this, like one gossip or speculation or assumption after another between title, real estate, and now mortgage that, it feels like I've been doing a lot of that this week.
Yeah, I mean, my inbox is still full of, I think today NewsZip has 24 active lender partnerships, and a few coming on board. And I think every single one of them has sent us a series of questions about, what all the NAR settlement buyer agent representation stuff means. And so that's what we've been fielding, but that is what we should be fielding because we're a business that sits in the middle of buyers agents and mortgage. so we're good people to answer it. And thanks for agreeing to come on our credit union kind of State of the Union webinar that we're going to do on that topic next month, by the way.
Yeah, I'm looking forward to having the conversation. I think that, one of the things that continues to come up is what's allowed and what's not allowed. And so as you think about like community lenders, community-based lenders, whether that's community banks, regional banks, or credit unions, you do have a lot of questions like, what should I believe? What's actually real? So I've been enjoying that process. I was doing some regional stuff around the NAR settlement, and it was kind of funny. You get different reactions from different people. So an example,
no doubt.
I was mentioning that, FSBO's never been a real part of the MLS. And the way I said it was essentially like, you're FSBO, you can't get on the MLS. Well, I got feedback from just one or two real estate agents, but they're like, that's misinformation. I was like, oh, really? I honestly, I was like, what did I say wrong? What did I do wrong? And like, well, you pay an agent and then you get on the MLS with your FSBO. And I was like, so wasn't I, yes, that's less than the representation fee, but like, isn't that still the point I was making? Like, are we talking about details here? Or are we talking about in principle? So
you know what that is? You know what that is? That's not a FSBO. That is, you signed a agreement with an agent who's representing you, they're representing you for a low,
for a
lower fee, but you know what it isn't is a FSBO. It might be FSBO like
300. Yeah, it's $300 representation instead of 3% representation, but it is something, not nothing. So yeah, but it's that kind of confusion, or that kind of, I want to be, I want to get the message clear, and it's like, yeah, but in principle, the message is clear. I started using the phrase. I used to use the phrase on podcasts and on different events. I used to use the phrase that the 6% commission was hard coded into the industry. And what I just meant was like it was part of the DNA of the industry. But I had to change that.
You're the problem. You're where these lawsuits came from.
But I had to change it to saying hardwired into the industry, because that distinction was like, people were like, well, it's not in the MLS code. And I was like, no, it's not in the software code of the MLS, but it's like hardwired into the contract that you sign, gets put on line.
Isn't there a legal term for that, where it's like it's not a law, but it's a custom, it's a norm, it's a, I think there's a more legal term than that, but it's like basically that. Yeah.
Well, in law school, you get more points for using Latin phrases, has been my experience. So
sure.
de facto. It's like de facto. It's like, hey, it's not actually a rule, but it's like a de facto rule because everybody's been doing it for 50 years. So it becomes like a rule in that sense. So yeah, but that type of thing, if somebody wants to be precise, if somebody wants to be precise, that's fair. Write the article, be precise. That's absolutely like, no, it is not in the code, but for all intents and purposes, here's how it acts. And so I do like that precision. I'm never upset about being driven to like more precision. And so that's,
on that topic specifically, we could talk for hours, but in 2018, 17, 18, I think 18, Rocket Companies acquired forsalebanner.com. I worked on that deal. I think you may have worked around that deal. And, none of this was all public information, mostly from Zillow, actually, that we were doing as third-party research. But at that time, Zillow was saying about 30% of people want to sell FSBO. And NAR was saying 8% of people do sell FSBO. And so that was like one of the things of like, I wonder, like both of those parties have a lot of bias. Zillow makes more money from consumers that want to sell directly or do some other type of transaction. But that number always stuck out to me as like, that is a huge difference. If 30% of people actually want to do it. And I think the truth's in the middle, where most people want a buyer's agent. And I think most people will continue to want a buyer's agent. That's what we do at NewZip. I don't hate that we're opening up the playbook a little bit again and saying people want to do FSBO, great. If people want to pay less for flat fee help, okay. Like it doesn't need to be quite as strong a custom. But I guess my point is like it was never fully a custom. There's always been
9% of the market or 8% of the market or whatever. Yeah.
For certain lenders that I've seen, it's been as much as 15 to 25% of their buyers don't have an agent. So it's like, a lot of arm's length transactions, parents selling to kids don't usually have agents in a lot of cases. What's the other one? Like rent to own or tenants buying from landlords almost never have an agent, buyer's agent. So all those things. So it's like, I just kind of keep throwing my hands up and being like, what actually is changing? This is like, now we're shining a light on that 10 or 20%, but, or maybe it's 9%, whatever the number is. But it's like, hey, we 6 years ago, and, I know decades before that, there were all kinds of other solutions, but you can say for a fact, 6 years ago, a mortgage company bought a FSBO site for this reason. So,
I'd be curious your opinion of this. So this is going to be like philosophical, but then literally I want to ask you the industry question. Yeah. But I always get kind of frustrated in meetings, and I don't know if you've ever had this experience where you're trying to talk about something, either a new idea, an innovation, a change, and somebody on the other side of the table uses the like one example from their personal life that either like does or doesn't make the point. So it's like, well, my aunt said, somehow you're in a conversation about this person's aunt when you're really talking about a business model or structure or product idea or whatever. And like it happens all the time.
Every day.
Yeah. So like I always try to avoid it. As soon as I'm about to say like this one time or I always like flag it in my head.
What about ism?
Does this contribute? Does this contribute to the conversation? But here, I admit, I have to tell you my own experience on this one, because I've actually done 2 transactions out of the 3 in terms of like buy side, sell side, buy side for the houses that I've ever owned. Mm-hmm. first one I did without a transaction because it was friend's mom. You know what I mean? Like,
arm's length.
we decided we didn't need it because she didn't even have to list it because we were at dinner and she's like, I want to sell my house. And we were like, great. And
that's even next level if you didn't even list it. So it didn't even, it was a totally off market. Yeah. That introduces a handful of other complications, but go on.
Well, we used, just in case it matters, I mean, kind of interesting, we used an appraisal. So we went and got an appraisal and she was comfortable using whatever came back and we were comfortable using whatever came back because then plus we could use that appraisal to get the
mortgage. That just like a verbal offer that like we will buy for appraised value
and like let's see, and make sure that it actually comes back and all that stuff. So that was cool. And then we sold that house under dual representation. Our seller's agent ended up finding a buyer who was unrepresented and did both sides of the deal. And so I've had both of those experiences. I don't think it's just because I experienced it. I think
when you bought, it was dual representation, or when we
sold that house. So we bought the house unlisted, we sold the house dual, and then the one I have here in Detroit, we did what I would call
I think the classic wisdom, which I don't know if I really buy, but I'll say it anyway, is that if the dual representation probably favors the seller, right? So you probably.
Yeah, I think so. I mean, I think
smaller commission and
In our case, it did balance out a bit, and here's why. They actually offered to rent the house from us, and so we could have actually kept that house and rented it out, which we should have done in hindsight. But I did not want to be trying to fix an older house in Connecticut from Detroit, so we were just like, no chance. But I guess my reason for bringing it up was I think I'm looking at this objectively and not because it was my experience in Connecticut. I think dual representation is going to become much more common. This is what I'm happy to be wrong about in 3 years, but it makes sense to me that so many people reach out to the listing agent because they found the listing and from some online service or from doing the fun part, which is the home search, that it'll become more of, well, can we all just do this? And if you put the right tools around that, like the right heat maps for pricing strategy and the right QC guidelines around certain parts, I think that seems to be a big opportunity here. And again, chips, the dust will settle and the business models will win or not win on the merits. But I have been bullish that the commissions will go down overall when compared to 6%, but they might not go down for individual actors who get to contribute more to the transaction. So I'm going to keep it at 3 and do both sides, or I'll do 4% and do both sides, or I'll do 3%. I'll do 3%, but I'm going to do more for you because I want to keep my 3%. Now I'm going to do additional services, additional products, additional data on top of what you're used to. And so I don't know, my view, I think I mentioned this a couple episodes ago, but my view is it's not automatically going down. I think it's just going to force everybody to do more.
Yeah. So we have, like I said, at the top of the hour here, we've been fielding this question a lot, as we should, because we help mortgage companies build real estate partnerships and programs. So it's super top of mind. So this is a mix of kind of like the party line for NewsZip, which I agree with, and my own conjecture. But one of the data points we've been using a lot is that there were a handful of MLSs in different pockets of the country that already made the changes that NAR is going to ask for in July, or the NAR settlement is going to force NAR to put in place in July. And so, for example, not having the buyer commission listed on the MLS, and third-party data says that there was like within an error margin of 0 change in commissions in those markets before and after the MLS showed the commissions. So, because at the end of the day, what's coming out of this lawsuit is super tactical. It's that you cannot put in the MLS the buy side commission that's being promised. And there's a couple of other pieces, but that's the main tactical piece. And so now, if you follow any of like the real estate or mortgage like meme pages or things like that, like Instagram or TikTok or whatever, they're all like making jokes of like, now you're just going to flash what the commission is everywhere else. You're going to put it on your, website, social media profile. You're going to put it on the house. You're going to do this. You're going to do that. The only place you can't put it is the MLS. We'll see what shakes out. Like that part isn't that important. But what did shake out in these markets is when it was removed from the MLS, nothing happened. It was the commission.
Can I ask you about a trend? So you just mentioned I can put it everywhere else. I just can't put it on the MLS. And I want to build that out from just commission to a lot of other stuff, branding, data, other things. So one of the things you know how sometimes you get something in your head from a product or innovation perspective, and it's like hard to let go, even though you don't know when in your career you're ever going to use it again. You remember, so we talked to Ribbon a lot. We know Ribbon as a company, and then of course EasyKnock acquired Ribbon and
right before I left EasyKnock, we closed on that acquisition.
And one of the things that Shavo and I had always talked about was the lack of branding around a listing. You do the yard sign, and okay, that's good. QR codes have become a thing, great. But there hasn't been like this house is brought to you by, or this house has these other sort of relationships and like building like, so this didn't, I don't believe ever actually happened, but maybe it did. Ribbon was kind of looking at working with like the Carolina Panthers to like brand a house in Charlotte that is like an attainable price point or like a community price point. And it would be like brought to you by the Panthers to help offset some of the marketing costs and like make it like a home ownership campaign for a big brand in there. It doesn't have to be sports, but I almost think it's time to like dust off that theory and think about it again.
Get Coke and Pepsi paying real estate agents instead of consumers. I like that.
I mean, we're really underestimating the advertising and marketing and other data related aspects here. Like one of the things I was thinking about was like, I have been talking a lot about lately, I think, as you know, because I've been telling you about it, but I've been talking with a lot of people about how fine art is inspected and appraised and sold. And fine art, these auction houses love that they're the brand, they're the expert, right? So Christie's or Sotheby's are the two that come to mind. And then it occurred to me,
and I've known this. Sotheby's, New York, whatever display every day. It's like 2 blocks from my apartment here in New York. It's pretty funny. I've gone in a couple times. They always have like hysterical stuff, like sports memorabilia or whatever.
That's what I was going to ask, because it changes based on whatever's up for.
Oh yeah, it's like a different exhibit all the time.
Yeah. See, that's super cool. And what I had realized, I knew it all along, but you know, sometimes you forget that the real estate piece is part of the same Sotheby's, right? Sotheby's has a real estate. It's the same entity. And so like, I do think there's like cool independent branding that means something that could come into the market alongside the agent or around the real estate brand and actually deliver consumers better experiences, different experiences.
Yeah.
I don't really think we've
scratched. There might be two different opportunities. There might be like a marketing opportunity, like, you know, brought to you by this company that either is related to real estate or not, and just getting exposure. Like your example with the Carolina Panthers, or my made up example of Coke and Pepsi, because they have the biggest budgets, or some of the biggest budgets. But I think you're introducing a second one. A second one is like you know, like StockX for like sneakers and like watches and whatever other products they do now, handbags, whatever, where they inspect it, they put the StockX stamp of approval on it, right, or something like that. I got that tour once. I'm sure you've done it a bunch of times because it's in Detroit. But that's kind of their thing, right? Is they like stamp it with like StockX has inspected it, and therefore this is a real, you know, Yeezy XYZ shoe.
I've got a couple pairs. I've done it. There was a pair of Adidas Calabasas that I was looking for. I actually won a pair at a charity auction from StockX. And I think you're right. I think I'm going to start thinking more about this, because I think
so. I think maybe there's two. There's the StockX or Sotheby's, and then there's also like the true marketing, maybe, or maybe they're one.
Yeah.
It seems like two different things to me.
Well, you know how everybody in mortgage is always like, what if Amazon comes into mortgage or whatever? Well, what would actually be better? What would be more interesting to me is if it was like brought to you by Amazon. Like we did all the Alexa, we did all the voice commands, we did all the security, we did all the cameras and climate control, we did all the energy efficiency. So like you could see
that's
people,
a good idea. Like all those ancillary products, right? Like
yeah.
I remember in like 20, it's kind of fallen by the wayside a little bit. It was maybe a little bit newer technology then, I'm not sure. But I remember when I first came in the industry, like 2010s, like up until 2015, 2016, maybe. I remember like the hot thing was defense companies, home defense companies. And I remember a number of partnerships. I think a lot of lenders that I've worked with over the years have had like really extremely profitable partnerships with home security companies. So that's an interesting example. Obviously, insurance companies, title companies, etc. I feel, people want that exposure. I mean, it's even like with leads, oftentimes mortgage and real estate partners in one capacity or another, there's some compliance legwork, and we actually don't play in this game. But like individual local realtors and local lenders oftentimes, pool their budgets together to buy leads, right? Or to throw events or whatever. So maybe it's not so far off from like industry sponsors, even whether that's the insurance company, title company, security company, et cetera.
So yeah, that brings up another point. So one of the things I've been thinking a lot about, I've been saying that it feels, and I this is just a feeling, everyone don't freak out and get all defensive. It feels
millions of listeners are going to be up in arms.
Yeah, I'm sure if Rick was here, it would be the most watched whatever podcast by whatever people on whatever day of the week.
On Friday from Detroit, New York, and
we don't even keep the time the same anymore. So Brian View, our one viewer, our very steady one viewer that we know we can count on, is like, I don't know, guys, you keep moving it around on me. You're really making this hard on your audience of one. Hey Brian. So here's what I've been saying. It does feel in this moment like you got these licensed experts who are used to comp or commission of blank, right? Seller's agent, buyer's agent, inspector, appraiser, title agent, mortgage loan officer. That's 6 before you get to a home insurance advisor or financial advisor or whatever else. So those six, which are directly involved, let's call it, is there room in this new transaction, new world, kind of and this is also true of like the economic conditions. This isn't just the NAR settlement. This is like where the demographics are going for home buyers, where supply is happening, what's going on with inflation and the Fed, and also all of those other, legal or regulatory constraints. So if there's not room for all 6 of those in the transaction at their current level, then what happens? And one of the things I've been thinking about is, what if these folks started creating independent teams? So instead of having your real estate team where the broker has a team and then they have agents within their brokerage, what if an independent agent goes out and goes, we've proactively created a team for you. We're still independent. We still work for our companies. We still abide by all those rules. But now Brock's team, there is a real estate agent, there's a loan officer, there's a lawyer, there's a lawyer, title agent, whatever.
Yeah.
There's this, whatever you can have, inspector.
Right.
And now like my move to stay relevant in this market, I'm going to go out, create my own team, and then deliver an all-in-one experience, so to speak, but without the big brand technology, the big technology investment that like an Opendoor is doing. I'm just going to do it myself in my town. And there's kind of enough overlap of technology now that you could probably create like a pretty helpful experience to consumers that just feels like hey, I got my team. Great. My realtor introduced my team, or my mortgage loan officer introduced my team. And I'm just going to take it on myself to create the all-in-one experience, even though I don't actually have a brand doing it for me. Your thoughts?
Yeah, I like that. That is not far off some of the stuff that we're working on at NewZip, where we present the concept of like a hub, where so we call it a home buyer trajectory hub, which is a bit of a long term. We're just calling it the hub usually. But the trajectory term is important actually, because it's like where they're at in their home ownership journey and how long we think it's going to take them to get the rest of the way based on data and what we know about their mortgage side, what we know about their real estate market, et cetera. But throughout the hub, which has, maybe I'll share an example at some point, but we throughout it brand like, and at this point in your hub, thanks for our sponsor, Verner's, Detroit's finest and oldest ginger ale, as I recall.
That's right.
So but yeah, so it's kind of like in context of like, this, talk to your mortgage team about this, talk to NewZip, your home advisor, about this, talk, you know, and we have the ability, and for some partners, we are putting in more roles, you know, sometimes, like our partnership with NewRez, they have mortgage operations people that use our platform as well. You know, so there's like the team expands and expands and expands, where you could have 17 roles in there if you wanted. But you'd have to give consumers the context of when to talk to who. But I actually want to back up a little bit broadly, because I want to keep thinking about what you're saying, but I want to draw a comparison to something that, like, if you've ever read any, you know, like sales, like, you know, methodology books, or like, you know, you've gone to like a sales seminar or anything like that, one of the things they often break out that, you know, like junior salespeople don't always recognize, is that there's someone that's paying, and then there's someone that's using, and they're very different. And not always, very often they're very different. That's certainly true of what we do, and most of the things you do, I think. So it's getting me thinking of like, maybe who's paying is not the user. Maybe who's paying is not, like, there might be a different, like, there might be a role where this person is truly more of a sponsor, or they're more of a, they're getting some other connection to the deal, because they're going to get the insurance, or they're going to get the, I don't know, I keep using the home security because it's a super problem.
Whatever makes the
best, like whatever
makes the most
like,
sense.
Hey, I'm going to sponsor this listing, and I'm going to, $1,000 to the real estate agent is going to come out of my pocket or something. I don't know, whatever the number is, that's too big for those, but like, maybe not too big for someone. Maybe it's like the MoveToDetroit.com wants to sponsor some home listings, you know, like there's, in Maine, we have stuff like that. Where there's like all kinds of like Move to Maine stuff, where it's like, we will pay you this much money if you move here and hire people, or those kind of things, right? So that get, like, that's not far off from real estate. That's close. That's very close to real estate.
You know, I was all over it when it was probably 2019, I want to say, something like that, where Tulsa was paying people $35,000 to move there, and I love that. So I used to write about it LinkedIn or Saturday Cup of Joe all the time, because I just think it's fascinating. I think it's the right, you know, it's the right way to push the market, learn things, try different stuff. But you're right. I hadn't thought of it that way, but my next belt real estate theory, right? I could create the next belt and be like encouraging people to move here by incentivizing them in the transaction. You want to own a home in Detroit?
And now I'm wondering if we're introducing like new bias, where now it's like real estate agents are going to steer people to those areas. But you know, it's fair enough. Well, when I first moved to Detroit, actually, they had the live downtown Detroit credits, right?
Oh yeah, that's right.
I rented the first year, and then I bought the second year, right? And they had credits for both. They had some sort of a down payment credit when I bought my house, but when I first moved there, they had a massive rent stipend if you lived within these certain sponsored neighborhoods. Brought to you by, you know, whatever, the Dan Gilbert and Co.
Right.
But that was like a cool example, right? Where it's like, oh, that actually, maybe I would have lived in the suburbs, and I didn't because it was sponsored. I'm glad it was. Yeah.
It worked. Yeah, that's the way I would describe it. The incentive worked. Like it did what it was supposed to do. Yeah, I've been, you know, as you know, I worked and I continue to work a lot on equitable housing and how we think about generational wealth across particularly discriminated communities. And one of the things I've landed on that is very similar to what we're talking about here is incentives or priority based on residency history. So we've started doing different ways that we tackle data, right? We're starting to look at rent data off the bank statement, or rent data out of the checking account, or rent data off of this document, or what have you. We've really done, I think Day One Certainty has driven a lot of mortgage companies to get the source of the income, not a paper document representing the source of the income, but the actual source of the income. And so I've been actually, so I've been thinking of this. How do you craft a housing program for first-time homebuyers that basically operates on this logic? If you've been renting in the same place for 5 years or 10 years, there's a pretty good indication you know that place. You're familiar with that town. You're familiar with everything. So could we give Detroiters, or, you know, people that live in Cleveland, I assume they call themselves Clevelanders, but I've never asked, so I don't know. Maybe I've never asked, so I'm gonna have to find that out by the end of the day.
Because they had that first credit. Yeah. Yeah.
I was just talking to someone from Oklahoma. I don't know if you saw this on social media, but I saw a plan to build the tallest skyscraper in America in Oklahoma City. And so I was asking somebody from Oklahoma, is like this making news where you are, and is it real or is it like a gimmick or a gag or whatever? Anyway, the response was, by the way, is probably a gag because turns out they have some tornadoes there and like
I was
huge buildings.
it seems
Not like it's not ideal.
Then again,
but who knows?
then again, sitting in New York during an earthquake today, the buildings did shake a good amount. So
hold on, we got to stop. I'll make my point in a second, but like that was pretty wild. So what was your experience? Did everything started rattling? Did you know it was an earthquake immediately, or like what was your thought?
I did not know it was an earthquake immediately necessarily. It was like it could have been like, you know, construction. It could have been any number of things, but it was like a 10 seconds of like shaking, like, you know, like the classic like dishes rattling on the table, things, you know, if you had any, you know, like if you had like a plate sitting somewhere, it would be like, you know, for like rattling. There's a lot of rattling. I'll put it that way. Like all this stuff behind me on these bookcases themselves. This is a real background, even though it looks kind of fake. Is all that stuff was like moving around a little bit, but no, it's totally fun. And
that's wild.
I'm in a 50-story building near-ish the top, somewhere in the middle, and it was more or less fine. But yeah, it definitely happened.
Yeah, that is interesting. So to get back to continue that point. So I think you could actually do a first-time homebuyer program that prioritizes those that already live in the community. So we think a lot about not displacing people. Like we want people to move to the next belt. I want people to come to Detroit to contribute and participate in the community we're building in Detroit. Cleveland feels the same way, Cincinnati, Milwaukee, right? But not to drive prices up and push out people who have been in Detroit their entire lives, their entire careers. Their families are from here. And those communities tend to be historically underrepresented and historically discriminated communities. So if you start to make some programming that says, hey, this program is for first-time homebuyers with a residency history in that town, with a residency history in that place. Now it is not about race or class or gender or anything like that. It's not even about income level, frankly. Now you want to make sure you're protecting income limits for especially people who are first-time homebuyers. We know don't have enough money typically saved up. They can afford the monthly payment because rent's still high everywhere, including Detroit. But my point is, I don't think we've done enough with residency. I think it's a really cool way to give some of that programming that the family of companies did to get you a house at your, opportunity in Detroit. We could do that for Detroiters using a residency history. And anyway, haven't really fully formed that idea, but there you go. Friday afternoon, wild idea that I'm continuing to think about for the next bell.
I like it. And I like the broader point of like, maybe we can separate the payers from the users, when it comes to real estate transactions, especially for first-time home buyers, like it's gotten really painful. What was the stat this week? It was like, there's 500 some towns in America where the average home listing is over $1 million. And there was like 300.
Oh, really?
Yeah. Oh, yeah. It was like it was like a clickbaity article this week. I think it was like last year there were 300. I think last year there were 350 cities and towns. This year there's like 500 that are the average transaction price is over $1 million. So, affordability is as bad as it's been in 30 years almost, maybe more.
I'd like to see I would love to see a map too. You got to assume it's like both coasts with maybe like Chicago.
Yeah, it's like 200 of the 500 are in California or something. But yeah,
is it?
But it's like there's a lot not in California though. I guess is like equally eye opening.
Yeah,
there were a lot of. I think it was like 100 some are like tri-state area around New York, 200 some are California. But that still leaves a couple hundred towns not in those areas that are average listing $1 million. There's some around Michigan actually, right? There's some of those suburbs around Detroit are probably right.
I would assume so. I can think of a couple off.
Definitely some of the ones around Chicago are for sure.
Birmingham, Michigan, but around Chicago, I'm sure there's a bunch. Interesting.
But yeah, so I think Rick is still going to try to hop on. He
Seriously,
his plane was delayed on the ground. He said he was supposed to get off at 3 and then call in and give us a bunch of his hot takes. So we'll see if we get that. But for lacking that, I'd love to hear what you think about the news related to Hunter Brook. I guess I would say related to UWM, but I think. I don't really think we have any like new takes on UWM, but the media model of Hunter Brook is kind of like what struck me as really interesting this week. What do you think?
yeah, I thought that was the bigger story as well. And when I say bigger story, like the actual content of the first release was not something I spent a ton of time on. I obviously came up, people asked about it. There was all the LinkedIn traffic about it, but I agree with you. I actually thought that the way in which people reacted to the model as if that was under some suspicion or like, well, you can't trust this article.
Actually, Jeremy, do you mind giving a little bit of an intro in case anyone hasn't heard of it yet? It's still like mostly industry media.
I can tell you what I learned from reading. Like that's all I have for this one. There were a few people in our network who they were contacted for the story or knew that Hunter Brook was coming as a business model, which I did not. So I learned about it all since it landed. But my understanding is creating a media company that is tied to raising a hedge fund, investment fund that will publish research, publish stories, and the fund will make decisions off of the market as well as all the information and research that is collected by the arm. The other thing that seems to be associated here is that the research and the activity has also been given or somehow associated to a law firm that is like potentially bringing legal action, but the law firm doesn't appear to me to have, it's not part of this launch. The launch was the fund and the media company. And my understanding was they launched the media company and the first story, and that first story happened to be this one about UWM. So it's not clear to me that it's gonna always be mortgage or home ownership, although I think being a hedge fund, it's going to hard to avoid financial services. Seems like financial services will probably be a pretty key piece if I had to guess. But that, they did a lot of research. That research led to a story. The story led to the fund rather, making a decision about their investments. And then they published both their story and the investment decisions on the day they launched the company.
My understanding, which I'm, no expert on the series of events here, but my understanding is that it also led to might not be right. Maybe it's following, maybe it's leading. I don't know. But at a similar time, a class action lawsuit started on the same topic, which was UWM's promises related to pricing.
So I think that
and not only related to pricing, but related to the brokers shopping pricing in more places and giving more options to borrowers, right? Basically.
Well, isn't that where this thing gets a little complicated? Meaning the law firm seems to have gotten a lot of their information from the story and from this Hunter Brook, but they didn't, but they're not associated otherwise with the fund, right? And so like, that's one piece of it that you just mentioned. Second though.
So media company breaks a story owned by a hedge fund, more or less, that is taking a position, which is taking a position related to the story and also kicked off a lawsuit related in some regard to the story, right? So there's like a few different things.
That's what made it weird for me to talk about this week, because some people wanted to use the relationship between the fund and the media company to just throw out all of their research and throw out their whole point. And I was like, that seems like a bit that seems like overkill to me. Like, meaning they could have a relationship. Some people on LinkedIn were calling it conflicts of interest. I'm not sure what I would say and what I mean by that is, they're publishing a story about their position. I don't think that's that different than somebody going on CNBC and saying, hey, I looked into this and our fund shorted it, which they say they disclose their positions when they interview people who have positions.
Doesn't a conflict of interest, maybe we're getting too technical here, but doesn't a conflict of interest imply that the two things aren't aligned? In this case, the two things are aligned. A hedge fund is using the same information that a media company is using. And
I think that gets at the key thing. I think some people, to be precise, you know, at the outset of this conversation, we talked about
there's
precision.
interest, but I don't think it's a conflict of interest. There's interest, but I don't think it's a conflict of interest. I think it's interest.
Yeah, if you're aligned, if your interests are aligned, then that's just what it is.
Yeah.
Yeah.
There's a lot of interests. So, $100 million hedge fund worth of interests. Yeah.
Well, that's kind of what I was getting at, was like, regardless of the motivation, there's a second question. So there's this business model. And then the second question is like, did any of their research or publication make sense? Right? That's the second piece. And so I think that's where it got complicated. I think the model's fascinating. I think the way that using media and using your investment strategy with the media to tell the world, this is what we believe, this is the investments we made, we put our money where our mouth is, that to me is like the future, I would say. I don't know, maybe not.
Yeah, I agree. Dr. Rick, 40 minutes and 30 seconds late to a 45-minute show. Chick-fil-A in hand. Love it.
From the drive-through. Yeah, my flight was a disaster. So I apologize to all the Real Friday fans, and certainly most importantly to you guys. So
we muddled through somehow without you. Yeah.
It's our highest rated episode.
I'm gonna have to watch the recording of this, but no, I mean, what an incredible! I kind of heard a little bit from 30,000 feet up. I logged in on LinkedIn and started watching you guys, and I mean, can this industry get a break? Like, we're constantly on, and this is one executive called me, and he was like, Rick, what's so hard is in a market where it's constantly putting you on the defense, it's hard to go on the offense, you know, and we're kind of in that period now of trying to figure out what the implications are of the UWM lawsuit, the NAF lawsuits, or the NAF lawsuits, the NAR lawsuits.
Careful.
Hopefully not
breaking news that we don't know about.
Hopefully not any NAF lawsuits. But no, I mean, it's really, you know, I was talking to one large $2 billion company in yesterday, and they were saying, like, Rick, we feel like now is the time to go on the offensive in the market to really sort of gain market share. But Lord, like, what's happening right now with all of these lawsuits now? What are the implications of this? What's our exposure on discounts? What's our exposure on how we're pricing out our customers in light of our competitors? A lot of us lenders, like, and you guys might know this, but we get a report of what pricing is in that local market of like every lender, and it's generally there's secondary capital market reports that you can buy, and it tracks like the lenders like A, B, C, and D. You don't know who the lenders are, but it shows you where you are in reference to your peers in that market. And generally, some lenders want to be the cheapest in the market. Some lenders don't really care. They want to be the most expensive. You know, my strategy's always been to be in the middle to maybe a little bit on the expensive side, but not super cheap, you know? And it's like what like pricing strategy goes completely out the window when
why?
If there's some expectation.
Why?
Well, no, meaning like if there's some regulatory pressure. Well, no, meaning like if you're sitting in front of the CFPB and they say, why were you in the latter third of the more expensive lenders on that day than the top 2/3? It just, any question from a regulator is never a comfortable one to have to answer if it's not clear and unequivocal. You know what I mean?
Yeah, but all I'm saying is that fair lending analysis and lending patterns analysis have been or should have been a major part of your compliance and review for the last, I've been in the industry. So I don't know that post Dodd-Frank anybody wasn't doing fair lending analysis, including lending patterns and pricing patterns. I think to associate this news with like added regulatory risk, maybe added regulatory scrutiny, but no more risk. The risk is identical. You've always had to do this analysis. Well, and as long as you don't claim you're something you're not, then you're totally fine. And I actually don't even know that I have too much concern about the claims associated in this specific story. What I saw wasn't even that. I'll continue to watch the research come out to see if they can make the case. But my point is simply that you got to do this analysis anyway. So unless you're out there claiming something that the data doesn't show, you're actually fine.
Yeah. Well, I think that's spoken like a good lawyer who would love to be on retainer to be paid hourly to answer those questions. But like to lenders, we don't want the scrutiny at all. Like, you know what I mean? We don't want to answer more questions we already have to, right?
So I mean, of course, but it's not like I think the question you're asking, it sounds like, is what does best price mean?
Yeah.
That's what you're asking. Yeah. What does best price mean?
100%.
Fair enough. Fair enough.
Look, and if that's true, and what's interesting is, and comment was made, the depositories are almost never the cheapest in the marketplace. They might have the cheapest rate, but they also tend to be the highest in fees. So how do you balance that out? You know?
What do you mean balance it out? They don't claim to be the cheapest.
No. Well, exactly. Well, I think that's no. We see this the same way, Jeremy. Just to calm that down. But I agree with you. You know, it's just.
It's a good way to win an argument. We're not arguing.
But, exactly.
We're definitely not arguing, but you keep saying it as if you either have to be the cheapest or somebody's looking at you and saying, why aren't you? But that's not really what's going on. So I'm curious what the concern is.
Maybe, I think it's just more of the tone of the UWM lawsuit, because that's a major part of the allegation is that, you know, brokers are saying, hey, we're going to provide you with the best option for you and your family. And then they're giving 98% of their volume over to UWM. And so they're basically saying, well, on that day, UWM wasn't the cheapest option, and yet it went to UWM anyway. So there's kind of a, you know.
That's true. I forgot about that part of the.
An inducement of the business.
And wasted this much money by using UWM. That seemed a bit of a reach to me. But
Brock,
I do agree that like a broker saying we shop thousands of lenders and 99% going to UWM, you know, like that's noteworthy. But UWM not being the cheapest every time is like, of course.
Well, and look, the reality is, you know, as sales professionals, our focus is to try to sell as much value as you can by charging the highest price that you can, you know, within reason, right? And there's an elasticity to that, but, you know, and that's the conundrum, right? It seems like it's a race to the bottom, and whoever makes the least, charges the least, saves the consumer the most, wins from the standpoint of the regulatory perspective, or at least these lawyers who filed the lawsuit against UWM. And it's just, well, it's offensive, you know, quite honestly, you know, but not to get.
Go on. Say more about that. It's offensive to who?
Exactly. That you need to be the
cheapest. Well, no, it's offensive to make that claim. It's offensive to sort of make that claim that the lenders who make the least,
I still want to
charge the least.
I still want to understand this. The claim is you promise the lowest price. Let's not even say best price, because that's actually too fuzzy in my opinion. Did you promise the lowest price and not deliver the lowest price versus I'm going to find you the best price? And did I find you the best price? Because those are two different things. If I am arguing about lowest price, I'm in one bucket with the regulator. If I'm arguing about best price, then it requires an analysis to say, what were the goals of this particular transaction? And then best might not necessarily be the lowest, and it's getting super conflated the way that we're having this conversation and the way people are talking about it. Lowest and best are not synonyms.
I mean, also a broker, like UWM presents a price, and a broker can position that price a few different ways, right? Like so it's not like, there was definitely an oversimplification there in the article. I think there was some meat in the article, but that seemed crazy to me, that they're like, and these many billions of dollars were wasted, or whatever the number was, hundreds of millions of dollars were wasted on UWM not having the best pricing. I don't know.
Well, that's why I didn't get bothered by the article, because I was like, if you're saying UWM didn't have the best price and we're defining best as the lowest available price on any rate sheet that day, then great, made your point. But if you say UWM didn't have the best price and then don't define best price, I think you got a problem. I think you actually have to get in the weeds and say what you're defining best price as. That's all. That was my only point.
And I don't see any way Matt settles on this. Ishbia he doesn't settle. Like he will die on the battlefield before he settles this guy's not a realtor, right? This guy's going all the way.
Shots fired. Shots fired.
Jeez, yeah.
Yeah.
Strays.
Love it.
Yeah.
He's no surrendering realtor. Listen to you. I'm putting words in your mouth now, but that's so funny to me. Well, you don't know what he's gonna do. It depends. Who knows what he's gonna do? I don't know. I don't know.
Look, I got a text message and a voicemail for him, and let me read it to you. It says, there's no effing way. I'm just kidding. I don't have any of that, but no, yeah. Look, I'm excited to see how this all plays out. But it's just there's got to be some kind of new normal in this business for us to be able to stabilize. Because amidst all of this confusion and this the market conversation, summer's almost here. And we're focused on putting people into homes. And for many lenders, I don't know if you talked about this or not, previously, but many of us just don't see that there will be any kind of rate relief here for this year. Whereas before the talk was 3 to 5 cuts. So there's a real possibility there's no rate relief this year.
Yeah, what do you think? Maybe one cut now, I think, is sort of the supposed logic. We'll see.
I don't know what the logic is anymore. I think the logic is we'll know when we know, and clearly. I think lenders need to just prepare to be in, a 7% range. I actually think we're healthy in the 6% range. I don't think we should probably be below 6, to be honest with you. I think a 6% market, 6.25%, 6.5% is a really healthy place, I think, for our economy to be in. Where we're not overextending ourselves, but we're still closing the affordability gap enough, but who knows what's behind the real calculus,
Yeah, I think as we're forecasting what our business and our lenders, partners, purchase businesses look like. The main thing we're hoping for is just like stability, right? Like let's get consumers comfortable that rates are somewhere and they're staying there, whether that's 6.8 or 7.1 or whatever. But let's not make it 8.
Literally, pretty much everyone, most economists will, know, especially real estate economists will say that if we get down to 6.25 or 6.125, we're looking at, $2.5 trillion this year. I mean, we'll look at a massive explosion of deals, in the space, because it'll unlock a lot of those that are looking to move, and it'll free up some inventory, and it'll just gobble up the existing inventory that's out there. And housing starts are, the new construction is really ramping up. I mean, we're gonna have good years in 2025 and 2026. I mean, monster years. I think we'll be $4 trillion by 2027. That's kind of my prediction, but.
What was the stat?
We back up.
Home inventory is up like 18% from where it was last year. That's nice to see. And that's massive. That's like new builds aside, really, because most of the new builds haven't come online yet.
Yeah, I mean, I don't know what's going to change behavior from a mortgage company perspective. If somebody didn't do anything 6 months ago to prepare for this moment in any kind of real way, I don't know why they would suddenly prepare now for whatever's going to happen in July, August, or September. Like, it doesn't make sense to me. The people that you're mentioning, Rick, I just like, I can't get ahead of this. Well, I get it. I understand that feeling, but like, always changing. COVID was a change. Dodd-Frank was a change. It's always that way. The one thing I learned from my very first boss at Quicken Loans was like the only constant is change. That's the thing you can count on, and it's changed. So that's the business we're in. And so if you didn't prepare a year ago, if you didn't prepare 6 months ago, what is it that just happened in April that made you suddenly be a new strategist or a new person? Is it this lawsuit for NAR? Is it the lawsuit for UWM? Like, this is what woke you up, maybe great. Like, let's go. Give me a call. Let's rock and roll. But like, it's just funny to me that you're like, yeah, we can't really prepare. We can't get proactive and strategic. You haven't been. So, like,
no, I know, but
do it this time.
But look, from a more empathetic perspective, I would say that lenders, it's hard when you're on defense and you're like when the rate adjustments occurred in 2023, it's like you lay off a little bit, you start reducing staff, you're hoping for things to turn around, you lay off a little bit more, you're hoping things start turning around. Maybe you add some more salespeople, but you reduce some ops people. I mean, it's like you're constantly on defense because you're reacting, and then all of a sudden there's so many movements in the market, forecasts in the market that end up that the industry ends up just betting on, right? As a whole, just the collective conversation just bets on these, and you just, but as these forecasts end up not coming true, you're just constantly having to react to what you think is going to happen but doesn't, right? And then there's lack of capital. I mean, when you have lack of capital, companies don't make good decisions when they're under financial stress. Humans don't, and companies don't, and when most companies are losing money, with the exception of a handful of servicers and those who have the reserves, they're not making good decisions. So you're always playing on defense because you don't have the money to go on offense.
Okay. And I guess I'm saying that, like, I am empathetic or sympathetic, but I also think that car companies would tell you they're in the same position. And I think movie studios and content houses would tell you they're in the same position. And I think, like, I could come up with a bunch more of enterprising industries and entrepreneurial industries who feel that they're very similar, and people find a way to reframe innovation or reframe the product or reframe the outcomes around technology, around efficiency, around partnerships. And, so
yeah.
I'm watching other industries respond and trying to bring that in, and, being told that's not going to work for us. Okay. But then them's the breaks.
Yeah.
Is he frozen for you?
Well, here's another. What's that?
No, I think I froze, but
another sort of breaking thing today was, and it's more on the industry side. Barry Habib announced that he's got like lymphoma, cancer, and he's gonna enter into some. He just sent me a text message.
Oh man,
I didn't know that.
It's just letting him know.
I'm sorry to hear that.
Praying for him and his family and all that jazz. No, I mean, look, a lot of people are plugged into his insights in the industry and in sort of the condition of the market, and so it's there's so much news, man. There's just so much news and so much going on. But yeah, just
for cancer, man. I'm sorry to hear that. Fuck.
Yeah,
that sucks.
So, but no, thanks for staying on for an extra 15 minutes for me, guys. This is great. I love being a special guest. I love being a special guest on our own show.
It's Brock's show now. You should watch the first 45 minutes. It's Brock's show now. He dominated, and so sorry, man. We'll have you back when we can. We'll find room for you in a couple weeks if we can fit you in.
We'll bring you on one of the shows in June if you want to.
Yeah, if you can make it.
Today's sponsor, thank you, Chick-fil-A. Thank you, Chick-fil-A, for today's sponsor. We appreciate you.
We also got Detroit's finest ginger ale, Werner's sponsorship.
Nice.
The first half.
Actually, Werner's. I think Werner's is a Buffalo soda. Isn't that a Buffalo, New York soda? Are they from Detroit?
I don't know.
Yeah, Detroit claims it, but it's been all over the Midwest. I think they make it somewhere else now. It's like Detroit originally in the 1800s, but I like it because it's delicious.
I love Werner's.
So that's all that. Yeah.
It tastes so much better than any other ginger ale. So yeah, I'll take it.
That's right.
Oh, no, I'm with you.
Great sponsor. All right.
All right.
Take care, guys.
Talk to you later. Bye, Jeremy.